Good afternoon, everybody. Uneducated economist here. Got a few articles I want to share with you guys. Links are down in the description. I always leave links down in the description for you guys. Wanted to talk about the currency issues taking place in like Ukraine, Russia, China. There is some major issues happening right now, especially when it comes to like the sovereign debt markets. Now, let's start in Ukraine because Ukraine is issuing out essentially what is a war bond. They need funding to fight the Russians, and the easiest way to get money is to either sell assets or take on debt. And the way they're taking on debt is by selling a bond. And this bond has an 11% yield to it. Now, when you consider the U.S. Treasury 10-year has like a less than a 2% return on it, getting a 11% yield on that bond is really good. But you got to think, this is money that you're lending to a government so that they can fight Russians with. The chances of you getting paid back is incredibly risky. So you're going to get a good return on that if they actually pay you back. That would be the question on it. Now, if you go and you read that article, you're going to see that the investors are talking about how difficult it is to even acquire these particular bonds. Like, you have to be an institutional investor or somebody who has like a serious purchasing power behind you in order to even acquire these Ukraine bonds. But if you go and you read the article, you're going to see that like some of the investors are saying that they would do better if they were to issue these things out in US dollars or euros. Not only would they get a better interest rate that they would pay back on it, but then the money that they would get would be easier to spend around the globe. And the investors, when they get the return, they wouldn't be paid back in sovereign Ukraine money. I forget what the Ukrainian dollar is, but they wouldn't get paid back in the sovereign currency. They would get paid back in either dollars or euros, which would make it a much more appealing bond for the global investors out there. But I found that pretty interesting to read that inside of that article. On top of that, the Russians, right? The Russians have canceled the coupon payments to foreign investors of their sovereign bonds. Now, to understand that, basically, if you had purchased into the Russian bond market, like if you bought Russian debt, there's a coupon rate to it. It's different from the yield. Like, if you're not quite understanding the difference between coupon and yield, if you can imagine, like back in the day, you used to get like an actual paper bond. At the bottom of that bond, there would be little coupons that you could tear off and go and cash them in. That was the coupon rate. So there would be a face value of the bond and then the coupon rate, which would have an interest rate attached to it. That coupon would be pretty much the interest that the bond would pay, but the yield would change as far as the price that you paid for the bond. So it gets kind of confusing, but basically the bond, the price of that will go up and down. The coupon rate stays the same, but the return that the investor get, that's the yield, and it will fluctuate on the price of the bond, however much the investor paid for it. So I'm just going to kind of leave it at that. But ultimately, if you had purchased into these Russian bonds and you are a foreigner, you're not going to get your coupon payment. They postponed that. They're saying we're putting a freeze on those things, and you can't even cash out of the bond. If you are holding that, you are frozen holding it. So that is a way that Russia has pretty much seized the money of foreign investors who are buying into the Russian debt. They basically just keep the money, so to speak. So I found that pretty interesting coming out of Russia, who is like in a scramble to try and find funding just about anywhere or keep the liquidity from drying up. And part of that is buying gold. Like, they had put themselves in a gold purchasing like position for years and years and years, and then they stopped buying gold for a couple of years. Now they're back into buying again, and I guess the idea behind it is that I'm assuming is to try and not only keep the gold within the borders of Russia, but then also add liquidity to the banking system, or just in general to the financial systems out there, by buying this gold up. And then on top of that, the Russians have a bunch of assets actually in China, like Chinese denominated in yuan, and they have that over in China as well. So this could be a way that they could actually deal with the fact that the United States has cut them out of the SWIFT system, so the payment system that pretty much the globe uses to do transactions. Russia has been 86'd out of this thing. They're like, you gotta go. You can't be part of the system right now. Well, they have established a lot of trade with China, especially when it comes to the energy. Now, there is disruptions taking place right now, and you can see that. Like, I have an article that talks about how the coal shipments have been dropped dramatically coming from Russia into China. But the idea that China has a bunch of these Russian assets that they can use for doing trade with, like, it's just like, hey, we need some stuff, you got stuff, we got money with you because you have those assets. This is a way that they can actually try and start that bypassing of the United States and the global system that has set up as far as world trade goes. Now, I couldn't tell you how difficult it's going to be to try and reestablish a new form of currency communication between, like, all the different nations out there who want to do business in Russia or China, while trying to navigate around that SWIFT system. That is going to be a very difficult task for them, but it's starting up, and that's something that we really have to keep an eye on. Now, you can see that it's just disrupting the hell out of all the currencies out of there. I mean, you can see the dollar is gaining strength like crazy right now, and it's because of all that fear. I mean, you see the fear taking place, you read it down in those articles, you know that people are worried about where it is that they have their money. And right now, the United States is the best looking place that you can go. It's surprising, I know. The money printer go burr. Dollar destruction is obvious. Everybody's saying it. Inflation is running rampant. There's no point in being in the dollar. The cash is trash, right? But that's where people are going. They're moving into the dollar. Look at the dollar index go up. Look at the treasury yields going down, even though the Federal Reserve is going to be backing off on their purchases. They're going to raise interest rates. Is it scaring the market? No. The fear of global turmoil is scaring the markets. That's what's causing the Dow to go down, even though it went way up today. I mean, it had a huge return, but it's been down dramatically over the last couple of weeks, and it's all based on this fear. And you see them, they're getting out of the market and they're getting into gold, they're getting into treasuries, they're getting into the dollar, they're getting into those safe havens, and they're not scared of of dollar deflation. Look at the bond market. Just go and look at the US treasuries. Go and look at the long dated treasuries. Those things are still at record low numbers, the yields that they pay. If people were fearful of inflation, they would be demanding a much bigger return on those long-dated treasuries. Those yields would be much higher, but they're not. They're low. And now you see the low end of the treasuries. Like, watch the 10-year, 2-year. This is the big indicator. If the 2-year yield rises above the 10-year, that is a sign of a recession coming. That is people very fearful of the present, not so fearful of the future. Like, the future, not so bad, but the current situation that we're in, that is a sign of major fear when you see that 2-year cross above the 10-year. And it is not that far away. I mean, it is almost there. So, anyhow, I'm going to leave it at that. Uneducated economist, you guys let me know.